lot of people have been talking about the first of a kind financing. So I'm enthusiastic and really looking forward to learning some new things this afternoon. Without further ado, I'm going to turn it over to Scott, who's going to introduce we're very grateful that he's moderating. He's going to introduce the panelists. Scott, over to you.
Right. Thank you. Yeah, come on up, folks. And how about you sit underneath your photo? That'll make it easy. All right. Well, we're almost last, but we're about first of the kind. And we've talked a lot about first of a kind projects all day today. So I'm glad now that a lot of the basics are sort of out of the way. And we've heard some examples and it's mentioning description of hydrogen for that and some of the other projects. And so here, I think we can really just dig into it, answer your questions, get into more about the specific details and what investors are looking for, and an entrepreneur who's navigated that space firsthand, how that's gone. So I am very happy to have the panel with me here today. And I guess what I'll do by way of introduction is let's just go down the row, but I'll have a question for each of you. Natalie, from Wollemi Capital, you're somewhat new to this space of first of a kind, and you spent a year or so looking at it. How about you just tell us about Wollemi Capital first, and then maybe like your quick observation as how the last year has gone, taking a look at the opportunity in this space.
Yeah, sounds good. Hey everyone, I'm Natalie Volpe. So I work at Wollemi Capital. Wollemi is an Australian-based investment firm. I co-lead our US team. What's unique about Wollemi is that it is a firm and not a fund, so we raise money onto our balance sheet. Roughly half of that is allocated to growth equity and the other half is allocated to projects and project finance. And so we are kind of purpose-built to bridge this gap between venture and infrastructure. I spent most of my career in project finance in the renewable energy space, and as Scott mentioned, the last year or two really exploring what it would take to finance these companies and these projects. And was your question what my observations have been?
Yeah, just give me like a quick, someone asks you in the hallway, how's it going with FOAK?
Hard. No, I think what we were talking about before is, we have a decent amount of capital that is allocated to invest in these projects. And I think the learning that we've had is, the money is not necessarily the problem. It is the projects. It's very hard to find good, investable, bankable projects. And that may kind of talk to a bit of what Emmanuel talks about of, does that all need to go into topcos, or do we need to fundamentally rethink how we finance this asset class?
Great, perfect. All right, Emmanuel, you're at KKR, obviously a giant private equity and infrastructure investor, but with a real focus on climate tech now and in a new group. It's exciting to have that in the market. So I guess for you, a quick introduction, but for KKR, I mean, I'm curious, when you were looking at FOAK opportunities, are you bringing the same mindset of the infrastructure investor, or how much of an adjustment is there in terms of returns and just the process that you're going to have to go through, the sort of brain damage to get through that when there are other infrastructure opportunities out there?
So when we started this new business for KKR, the climate business with Charlie, the other co-head, Charlie was at Goldman Sachs Asset Management for many, many years. He was leading the team that did Redwood Materials, Northvolt, and other big things like this. And I was at Schneider Electric for many years. So basically what KKR does here, they take an investor who has done a lot of first of a kind and big stuff in decarbonization, and industrialist, put us together and basically told us, guys, we want to build the best and climate business in the asset management industry, but something where KKR can bring value, right? So, because today, we're definitely not the first ones in climate. So there's a lot of infrastructure funds that do renewables, and this is a well-known entity and very mature world. Where infrastructure funds are very comfortable, but there's no first of a kind here. It's like the hundreds of a kind, no, and or in the thousands. And then there's a lot of climate tech, well, KKR would not be relevant anyway, and then I think it's a space that is very well covered. So, but the reflection with Charlie and the rest of the KKR team was like, well, there's that missing middle where things really become capital intensive. So usually that's around the first of a kind. Now, the more we go into what we do, the more we think that maybe first of a kind is not the right definition. So because it's going to change, whether you do batteries or green molecules or regenerative agriculture at scale or different things. Yeah, there's a notion of that's the first time you do something at a very large scale, but first of a kind may be a bit misleading in some cases. But definitely our conviction is that there is something in the middle, that where the growth equity and venture recipe doesn't work anymore. It's too big. You cannot apply the same recipe anymore. And where it's too early or too risky for infra funds. So there is a pocket in the middle, which we consider as an opportunity and a new asset class, if you will.
Excellent. Yeah, I've heard it referred to as early infrastructure.
Yeah, emerging infrastructure, early infrastructure,
right.
Growth infrastructure, not growth equity,
yeah.
not infra.
Exactly.
So we'll see how.
And Shreya, you've actually, you're co-founder, CEO of VS Separations. You've actually done a first of a kind. More than one, right? Are you on?
Just one.
Just one, all right.
Just one. Just one first one.
You have done first of a kind, all right. So yeah, talk a little bit about your company, and then I'll have a bunch of questions because I think you're in a great position to give us the lessons learned and kind of the state of the state.
We've learned a lot of things. My name is Shreya. I'm the CEO of VS Separations, and we decarbonize industrial heat by transitioning the separation step, which is a very intensive. We've done it the same way since the Industrial Revolution with a mechanical-based separation that offers 90% less energy on a joule-for-joule basis and a fully electrified process. So we have big carbon impacts even before we get to the renewable grid that we are all headed towards as well. And so there's sort of this dual carbon step down. We've scaled up 100 million times to get to our first of a kind. So we spun out of MIT in 2017, been supported by venture investors, the Department of Energy, National Science Foundation, out of DOE specifically, ARPA-E, and delivered earlier this year our first of a kind. I think it's important to define what it is because it's a catch-all phrase. For us, we deliver projects that are roughly $20 million ticket size to industrial manufacturing facilities, so inside the fence and integrated into their existing operations. So number one and number two priorities are safety and reliability, not disrupting operations, and number 3 and 4 are the cost benefits of the technology as well as the decarbonization aspects. So we've got 2,200 odd hours of operation of this project, and I think a couple things that we've learned is, lower cost is better, right, for our customers, for us, for a lot of reasons. But a lot of infrastructure investors that we're looking at down the road are looking for much larger ticket sizes. And so thinking about how do we bundle projects together, because being a larger project just for the sake of a larger project isn't the best strategy. We've thought a lot about how to operationalize and what we can kind of commit to on that cost down curve. So we look at our cost down purely from a technology package perspective. We don't assume any learning curves or like unknowns that just don't exist. We don't have empirical data for climate. And then very importantly is we deliver to our customers value with no green premium. And so that's been increasingly important as we've talked to customers, as we look to scale as quickly as we want to. And so they're seeing operational cost and stability benefits. Again, number 1, number 2, safety and reliability. If they're seeing reliability benefits, then they're getting out of bed for it. And the decarbonization aspect means that we're market agnostic from a tax or credits perspective. And can scale more quickly as a result. I don't know if I answered your question.
No, that's great. There'll be plenty more. I guess the next thing that may be instructive that we didn't hear a whole lot about today that's worth describing, Sightline calls it the FOAK smoothie, that like it's clearly just a lot of blending of capital into one of these projects, and from traditional equity to catalytic capital, maybe family offices involved, strategics, government, OSED could have money in it, the customers. So I assume there isn't a standard mix yet. It's still early days, and every market's a little different, and every moment is a little different. But maybe it's worth describing, if not the typical one, but just what you've seen out there in terms of how you get a first-of-a-kind project done in the different types of capital. If you're trying to get to $100 million, like, how do you cobble that together with the different sources that are out there for that? Do you want to?
I can jump in, and then maybe Shreya can share her lived experience. But I think the thing that we always talk about first of a kind is that each project is its own special snowflake, and so they all look quite different. And so the capital stack that works in one deal is just not going to work for the other. And so one, needing to be really creative and flexible about what those different pools of capital are. So obviously there's everything from venture capital, which is companies raising money onto their balance sheet to put into the projects, to people like Wollemi, to people like KKR. But then you have things like concessionary capital providers, whether it's family offices or the government, I think are all kind of different things to pull from. I think what I get concerned about is, as we think about the need of capital and scale in this space, that is not a very scalable solution. It takes a very long time to do these deals and to find these different pools of capital. And so I think the market does probably need a more templatized way of doing this, but I think we're still in that learning phase.
Yeah, Emmanuel, do you see that? And maybe comment on Europe too, if it's how different it is or unique from the US.
Yeah, I don't think it's that. I mean, the ecosystem of how governments will play, and the Green Deal versus the IRA, there are some differences, but for the rest, it's not that different. If I try to define that stage, because you're right, Scott, it's a bit of a gray area today because it's new, right? So it's frankly speaking, at scale capital to build a project. Well, aside from renewables and a few battery stories, large scale batteries, there was nothing so far. Now there's more and more technologies and companies that are coming to that space. I would say the first thing, of course, zero technology risk. It should be behind you and long time ago behind you. Unit economics are proven, and probably you already have some cash flow trickling down the P&L. It has to be capital intensive, because this is the main difference, right? So between climate and this is why everybody is talking about the valley of death, because the recipe to scale up asset-light companies or software, that's easy, right? So that we've been doing this for the last 40 years. Everybody can do this. Any VC can do this. You reach your Series D, you have a bit of cash flows trickling down the P&L. Next stage is an IPO, because you don't need, as soon as you generate cash flow, you don't need to raise money anymore. In climate, that's not true. You generate cash flow. That's probably the signal that you need a couple of billions, and that cash flow is never going to give you that couple of billions unless you're ready to wait for 25 years. But so that's keep it capital intensive, because sometimes people really want to force that SaaS model or that AI super asset light model into something that is inherently capital intensive. And that's a big mistake, because this is where you leave a lot of money on the table. You get your IP sucked by an incumbent because, I'm going to do a licensing model with incumbent XYZ. Well, that's the best way to lose money. Or you try to force yourselves into making it look like a software. If you're making stuff, you're making stuff. So that's and capital intensity is precisely what people like us like. Now, there's a number of risks. Construction risk, scale-up risk, that still need to be addressed, and this is why we think that new missing middle category should address. right? So those are the risks, the scale-up risk, the construction risk, the development risk that infra investors would not take yet, but that growth equity investors cannot take anymore because it's become too large, right? So we're talking about, on average, our check size is between 500 million and $1 billion per deal, right? So this is so there's no growth equity fund that can follow this. And if you're in that zone and if you need that type of capital and you're still raising money, distributing minority tickets, quote unquote, and you're probably getting into a risk in your capital stack that is beyond comfort. And we've seen a few examples of companies that went over their skis, went too far, in trying to stretch that growth equity or venture mentality, and are in trouble because of that.
Yeah, and that capital isn't very cheap anymore.
Yeah.
So it's hard to keep doing that. Shreya, what was it like putting together that capital stack for your first project, and how replicable is it? Like, is second of a kind going to be easier, or do you need to get to 6th, 7th, 8th, before you can stamp them out?
Definitely not 6th, 7th, 8th, but I do think there's a world of second, third of a kinds that we as a society haven't seen a lot of them, and we're going to start considering them part of a valley of death going forward, because I think a lot of folks have looked at, okay, once first of kind done, it just like unlocks everything all the way. And to some extent, that's very, very, very true. But it is not, you don't go from zero to bankable overnight, right? There's no threshold, even though a lot of folks look at, 1,000 hours, 2,000 hours, 5,000 hours. There is no like tomorrow, there's no technology risk. So I think we think about two things. And I want to speak to the technology risk piece of it. But the first thing is speed. A venture-backed company on the venture treadmill, right? And so thinking about how quickly we can deploy. And so we made trade-offs around logistics costs, for example, just to deploy faster, because the alternative is burn. It's not it's balance sheet capital, but it's expensive equity dollars. And the second thing related to speed is that we took equity dollars on balance sheet to deliver that first project, along with some equipment finance, a little bit of venture debt, because financing it couldn't be the bottleneck. At this point of the company, financing it should not be the bottleneck, because then we're just burning cash, not delivering, and not creating value, not proving, not getting to that burden of proof. The second thing I wanted to talk about was thinking about like what is technology risk, right? And who you ask that question to it changes the answer completely. For a industrial customer, something that hasn't been deployed couple dozen times, been in operation for a couple years, right? There's perceived technology risk. For an venture investor, there's zero technology risk once you've done a pilot, right? Because what is it? It's just engineering now. There's no scientific risk. Coming at it from a scientific perspective, I agree with that perspective. And then there's everything in the middle where, okay, well, this works at a 1/100th scale. What does 100x look like? And those mechanics actually differ. So it might be different for a cement plant than it is for what we're doing, an inherently modular system. It might be different for hydrogen. I don't know. I can't speak to all the technologies, but I think that creating kind of a shared vocabulary around that, it's starting to happen. But I can tell you 2 years ago, there was no kind of real right conversation about it.
And maybe I could jump in on a shared understanding of how to price that risk. I think, as an infrastructure investor, I look at risk much differently than a venture investor, and explaining that to founders and CEOs can sometimes be a bit of a disconnect. And so, as an infrastructure investor, one of the reasons to do first of a kind projects or second of kind is because you think you can get higher than average returns on projects if you're otherwise just going to be doing solar and storage deals. And so just getting above that hurdle with companies to say, okay, it's not venture style cost of capital, but it's also not 10% bank debt. And then also, we expect risk to step down project after project, but it does not just dramatically drop off. And I think trying to chart that out, I think, is a reasonable path to lower cost of capital, but doesn't happen overnight.
Just to add on what Shreya and Natalie were saying. You can call it technology risk. We tend to call it scale-up risk or industrialization risk, right? So typical case, so the technology works, everything works, but you've done 10 of the thing. And then in your first of a kind, your pipeline, you have done 100, and now you have to do 1 million. So that something will happen when you go from 100 to 1 million. Something will happen. It's not a technology risk, if you want, but we could call it a technology risk. It's how can you industrialize at scale. So this is why you have to remove all the risks from the table, because that one is going to be extremely hard to address. So that's point one. And usually when people get to that point of going from 100 to 1 million, they are usually the first in their category. Right? So they have a first mover advantage. And because they come from a VC mentality, they can become very greedy. And we encourage them to think differently. You say, no, look, why don't you be reasonable on price? Because eventually your green premium will disappear or will not be tolerated anymore at some point. So just try to think about what your price will be in 5 or 10 years from now. Just price a little bit a part of this. Don't try to be super greedy and monetize right now all your first mover advantage, because guess what? There's someone in China or somewhere in the world that's doing exactly what you're doing. They're going to show up in 2 years and at half the price of what you're doing, and that's it. Your advantage will be gone. On the other hand, try to get your customers under contract. Try to make it look like a bit more like an infra thing, so that when the Chinese guys show up in 2 years from now, well, there is no customer to talk to because they have signed 5 years of their contracts with you. So this is where we start shifting slowly but surely from a growth equity mentality to a bit of infra mentality. You cannot, and the third point, you cannot go full infra. I mean, I've seen people pitching me sustainable aviation fuel plants with a 7% project IRR. No, that 7% project IRR, that's solar, that's mature, something that's been going on for 30 years. Everybody can do it. It's super safe. Actually, those companies that were pitching this a year ago, more or less, they don't exist anymore because they really thought that going from venture mode to infra mode straight away was the right way to cross that chasm, that valley of death, and they didn't survive. So that's important to keep in mind. Those things take time. It's hard. You're building hard stuff. It's going to take years to get there.
Right. Well, let's talk a bit. I'm curious what you think if you were making like a heat map of all these hard to abate sectors where maybe some things are easier than others. Like, I mean, I guess we should just, reiterate the importance of hard tech in climate right now, that the next hard things like long duration energy storage or sustainable aviation fuels, cement, steel, carbon removal, there's lots that go into this category that are now out seeking first of a kind financing for projects. These represent just massive decarbonization opportunities. And I think the interest in it, there's a lot of pressure in it externally because we really can't wait. You know, these could happen naturally over decades, but like if we can really accelerate that and get innovative with financing, you can really accelerate the decarbonization potential of these sectors. And I guess I'm curious, like as you look across the different sectors, are there differences? I mean, are the strategics more mature in some than others? Are sort of offtake agreements easier to come by in some sectors than others? Where some you may have to just be inventing a whole way to interact with a customer. So I'm curious, if we think about FOAK over the next 10 years, are there some sort of early leaders and others will be coming up, or do you kind of treat each project individually?
I have a bit of a hot take, which is there's not a lot of companies deploying carbon abatement today. And there's a very real-time value of carbon, to your point. And in the industrial sector in particular, having the opportunity to kick the can down the road, and I'll use carbon removal as an example, it's very important. It's going to be very, very critical to our portfolio of climate. But the, whatever VP who would have to put their neck on the line for decarbonization technology today, looking at carbon removal economics for a project that will get FID in 7 years from now, they're like, yeah, I'm going to wait for that. That looks great. We're 7 years away. I don't have to worry about it, and I can hit all my goals and targets. And I think we need to be looking at, how do we scale today? How do we get deep today, deep and broad? Just to and there's no way to put a time value of carbon, a price on the time value of carbon. No mechanism.
I think the deals that I've seen announced, and I don't know the conversion of announcement to actually steel in the ground, but I think you do see a lot of SAF projects getting announced, and I think in part that's because we found a way to get creative on the contracting by separating out the physical commodity with the environmental commodity, and you're seeing the Microsofts of the world sign up to take that green premium, where generally we don't underwrite green premiums, but I think this is an exception where we think that there's a durable green premium there. And so we've talked a lot about offtake today. Generally, if you have someone that's willing to put their neck out and put an offtake in, then projects will follow.
Right. Yeah. No, we're definitely seeing it. Geothermal benefited from a clean transition tariff. There's probably some small nuclear that's going to benefit from long-term contracts. I mean, curious just to stick on the topic of contracts. When you're building a team, when you're looking at a company to invest in, and looking at maybe typically in that market they're going for, it's a spot market, and they need to actually introduce a long-term contract, or it's a 3 to 5 year contract market, and you really need 15 to 20. Are the startups in that space, are they ready to have those kind of conversations? When do they do it? How, as an investor, are you helping shepherd that along, or are you leaving it to them? I've just noticed with a lot of these, it's really having to change the whole dynamic of a space that never had an interest in that, but they need to now for the sake of decarbonization. So what's sort of the process around that when you've encountered it?
I would say here well, you have to understand first, you have to understand very well the supply chain you're getting into. It's not the same thing if you're in energy, electrification of transportation, hard-to-abate sectors, or industry in general, or agriculture. You will face more or less fragmented supply chains and more or less value, because you're going to come with a green premium at some point at the beginning. Now you better be sure that that green premium will be either absorbed by that supply chain or disappear relatively quickly, because otherwise, if there's a green premium and we continue subsidizing or creating inflation in the supply chain, at some point the music will stop. But it's really a function of how a supply chain works. So for instance, if you look at what's happening in green steel in Europe. So that trick works in Europe, doesn't work in the US. In Europe, basically, because the regulatory framework with the CBAM and the ETS has created a favorable environment for green steel makers. So today, Mercedes, BMW, Volvo, Scania, they're all happy to pay 40% more for a ton of green steel. And it's a good deal because at the end, it's only going to be 150 euros per car of extra cost. Easy to absorb as a green premium, and anyway, that's going to prevent them from having to pay fines down the road. Now, steel was a spot market in Europe. Then the green steel makers came in and said, no, you're going to have to pay 40% more for my steel. And by the way, I need a 7-year contract. Take or pay. Which at the beginning, all those procurement people in those large European automakers, they didn't like to hear this. They all ended up signing. So how did they manage to do this? Well, with the help of investors and also playing a bit on the scarcity. Right? So that was done by one company called H2 Green Steel, or now it's called Tegra, I guess. They forced a bit the thing and they played on the scarcity. Yeah, I'm the only one supplying green steel. So you have several levers, but what I mean here is that you have to understand very well the type of concentration and the willingness of companies and your final customers to get in. Because if you go to the food industry, you try to do the same trick. on sustainable coffee, sustainable cacao, and try to have Nestle or Mars paying 40% green premium on such things, not working. Why? Because the agriculture supply chain is much more fragmented. You have a lot of middle men. So just the structure of the supply chain is different. And also the value that the final off-takers are putting on that sustainable supply is not exactly the same. So the message is that, yes, you can do it. You can force your way into it. You just have to understand very, very well which industry you're playing in.
I completely agree, and a little less from the supply chain angle and more so from the creating value for the customer. So when we're talking to industrial customers that don't typically look at long-term offtakes, they are when it means that their operation is going to run more smoothly. That's more interesting than the decarb. They're like, well, what if the policy levers swing in the other direction? Hedging on even price of their commodity product, right? And so where we found a lot of success in like 5 or 10 times longer contracts than our standard in the industry is where we are solving their actual operational challenges, and the decarbonization aspect is an added bonus.
Sure, you brought up something interesting, and there was a couple of conversations I had today about this. Like, is the business model something that would evolve from first of a kind to nth of a kind, where at the beginning you sort of sell it as something as a service, and then eventually you're selling an asset, and there'll be an asset code. Like, how often is that going to be part of first of a kind, that the business structure under which it operates starts in one direction, but it's pointing in another direction once it gets to nth of a kind and more mature?
I think almost every time in terms of spreading risk. So in our first of a kind project, we take on no market risk. So our customer is taking on all the market risk on their product, on everything. We take on no electricity price risk. That is also something that is on the customer. We only take on the perceived technology risk. And obviously delivering that project working matters, whether it's a service contract or a capital sale. It doesn't really matter for the first few in our sector. And we got to deliver it working regardless. And so it doesn't feel like a big risk that we're taking on as a result, since that's kind of table stakes. We see, for example, two paths. We have customers who want to use their very low cost of capital to deploy more systems faster. And then we also see a path where we can have a shorter sales cycle and a more aggressive margin in a service model. And so we see benefits for both, and we're going to test the hypothesis out in the market and sell both for a little while, to the point where we have the scarcity, the power to say this is the only way we sell down the road.
And maybe one comment on that, I think we definitely see that evolving of it's easier to get in market as a service. It removes the step of having a big industrial customer, a big just corporate put that on their balance sheet. I think what we think about is most of these companies, before they've built a first-of-a-kind plan, are amazing technologists. They have the smartest people in the world building the most innovative technology. To be an as-a-service company, to actually build, own, and operate, or build and operate, not own, that is a fundamentally different business than just selling something up front or licensing a technology. And so then, even as just pure project-level investors, not even a corporate equity investor, we look at the team to say, is this a team that can actually build projects and develop projects and own and operate them for the long term? And it's not a bad model. There's tons of really successful developers in the solar, wind, storage space that have done quite well, but that is fundamentally a shift in probably the business they thought they were building when they first started developing the technology.
The thing I would add, over the last 30 years, because of the explosion of tech and also because of Tesla, everybody's been dreaming of, the IPO has been the panacea, right? So the last destination is to be a public company. It's not fun to be a public company. It's tough. Public markets are very, very volatile, very short-term oriented. That's definitely the opposite of patient capital, if you will. So, and you still need patient capital, and you're probably better off. So the good news is that firms like KKR have seen this opportunity, and we stack up a lot of financial instruments to basically for companies to grow at a very, very large scale without having to go public ever. Because not everyone is going to be Tesla. And it's okay if in 10 years, in 15 years from now, you're on the balance sheet of a corporation or you owned by an infrastructure fund, right? So infrastructure funds today, at least at KKR and many other managers, those are not guys doing toll roads and airports, right? So that was infrastructure of 20 years ago. So those are people doing fiber networks, data centers, supply chain for beverage companies. So basically the definition of infrastructure is basically the lack of volatility due to GDP and some downside protections. But that's not about toll roads and airports. That was a long time ago. So by the same token, so those are the infrastructure funds today which are underwriting billions and billions in data centers, right? So it's very reasonable to think that many of the companies here in 10, 15 years from now will be owned by, and will be very happy and very big under the umbrella of infrastructure funds with that definition, right? Just like solar and wind 20 years ago, where many of you are, and now it's part of the infrastructure fund playbook in many cases. And I think that's probably a much more reasonable path going forward than trying to dream about big IPOs and things which probably bring more headaches and risks than upsides.
All right. Good news for KKR. All right. Let's have some questions. We've got eight minutes, so hit us up quick.
So we're in lithium, right? And lithium has been a roller coaster since pretty much the big shift towards the battery focus over the last 5-6 years. So when we started, it was $4,000 a ton, then shot to $80,000 a ton 3 years later. Now it's about $10,000, $11,000 a ton. And so for the long-term offtake, going to like infra type mindset, we're looking at 5, 10, 15, we can't get that yet. In 10, 15, we will, because it'll be a very stable market. But until that point, I mean, how would you see funding it?
Again, I think that's all the metals supply chain, right? So we're shifting from a molecule-based economy to a metals-based economy. There's enough lithium, cobalt, copper, manganese, everything we need to electrify the entire planet and make all the batteries we need. There's enough of it under the ground. We just need to mine it, process it, prepare it, right? So there's a huge upside in this type of thing. So there's no such thing as peak lithium. There's enough lithium on the planet to electrify the entire economy. Now we have to organize that supply chain. Now, when you look at lithium, there's a bit of volatility because the market is getting there. We have to design the supply chain. Nobody really knows. Plus, you have a bit of geopolitics in the mix, and that's going to make the short term at least a bit spicier than it should. But at the end, it's reasonable to think that the long-term return in 15 years, 20 years from now will probably be in the 7, 8, 9% return over capital employed when you've done not your first of a kind, not your 10th of a kind, your 20th or your 25th. So that means that by then you'll probably either be part of a big group, BHP, Rio, one of those, or on the balance sheet of an infrastructure fund. So this is why we think this is the path. Now, step by step, right? So it's probably going to take 10 to 15 years. Don't rush there because you would make mistakes that are not probably reasonable. That might take. But you're probably onto one of the most exciting industries right now. Not always fun, but it's promising.
I'm curious when you think about blended returns in kind of this messy middle early deployment phase, how much does access to the deal flow come into your thoughts? Because one thing I've thought about is it's clear, at least that it's starting to be the case, that demand for a lot of these clean tech technologies is starting to outstrip supply, and there's certainly going to be a situation where it's supply limited. And I'm curious, especially when there's a learning curve in understanding how to underwrite some of these, how much does access play into how you think about returns?
Yeah, this is a constant battle, I would say. We don't ever want to just do one project. As I said, it takes a lot of brain damage just to figure out how to underwrite one deal. So we both want to, amortize those learnings, amortize that cost over a pipeline. The question is, how big is that pipeline? Is our cost of capital right for that? When does it graduate to someone like KKR? And so I think that's some of the nuance there. And that's, as a flip side, as a CEO, they never want to do that, right? Because they want, as you rightly mentioned, there's a supply shortage. And so they think they can get better terms elsewhere. But then you have to think of, well, I'm taking the most risk up front. And so I want to be able to benefit from that reduced risk curve, reduced costs, and things like that. So I think it's totally part of the package, and is also part of the learning, I think, of this space.
Any others? No, there you are.
Yeah, I think a lot of what was discussed for when your end customer is a large business or enterprise. I think when a lot of new product, for example, our product is fully retail, right? So in India, there are 20 million people who buy vehicles every year. So we're seeing a huge challenge when you start looking at electric vehicles and financing for electric vehicles. So any learnings on how this is solved for solar in your experience, and how do you solve for financing where not just your supply chain, but even your demand is fragmented and you're sort of selling to 20 million people?
Yeah, there's let me give you two data points. Completely in the EV market, but completely, I would say, opposite sides of the market. So one was with the CFO of Porsche a few weeks ago, and they were worried about one thing, which is the thing. So if you buy a Porsche, this is an investment, right? The value of the car, if you buy one of those cars, of Porsche, Ferrari, the value of your car is going to increase over time. And the guys were like, yeah, but we don't know about the future value of an EV. And it was interesting because we said, well, with an EV, you can swap the batteries every 7 or 8 years, or whenever you want. Even put the latest technology batteries, and then your Porsche now, instead of 0 to 60 in 3 seconds, is going to be 0 to 60 in 1 second. So you're going to improve the product over time, and not even talking about software. So, but that they were a bit stuck in that, and that was surprising because Porsche probably has been one of the most innovative incumbents in the shift to EVs. So there's a bit of mindset shift, right? So because there's an advantage where they could realize that value of their cars being an investment. The other thing, which is, so that's on the commercial vehicle side. We are financing a lot of fleet transitions today. So when you transition a fleet of trucks or buses from diesel to electric, a lot of fleet operators are stuck with the fact that, but the vehicle is very expensive. And it's true that if you take the vehicle at face value, the premium is very high. Now we say, no, let's do something here. So let's finance the battery separately from the vehicle. The vehicle, you can finance it or lease it or buy it, the same as usual. We're going to finance the battery and bundle the battery actually with the charging infrastructure in your warehouse or your depot or wherever the vehicle is going to come back at some point during the day or the night. So now you have a vehicle without a battery. I mean, the battery is physically on the vehicle, but from a financing standpoint, it's out. You have a vehicle that is cheaper because there's no engine, no battery. So it's cheaper than the diesel version. So the green premium struggle is gone. And then we are going to finance over 10 years or 15 years a bundle of the battery plus the charging infrastructure, which we built for them. So, and at the end, that leasing cost over 10 years, 15 years, on a yearly basis is roughly the same as the cost of the diesel they were paying before. So for them, you basically realize the promise of having a TCO in electric fleet being lower. And so there's a lot of ways to finance your way out of it, and it's very, very sustainable over time and very solid business.
Okay, we hit time. Thank you very much to the panel. Thank you for your questions. Appreciate it.